Reasons for debt funds downfall. Is debt fund still a good investment vehicle? To help you gain more clarity on this, we have our investment expert Mr. Chintan Arira with us. Chintan, over to you.
On the debt funds, of course, why have been the returns so low? Because if you look at the previous time period, the interest rates came down very sharply and were low. So in debt funds, how it works is when interest rates come down, the price of the papers go up. So you make money by interest rates coming down and prices go up. When interest rates go up, the prices of the paper come down. So what has happened in 2020 and 2021, especially after COVID, where globally interest rates came down and even in India, the interest rates came down, you didn't make money in liquid, you didn't make money in shorter term funds, you didn't make money because interest rates came down very sharply. Unlike a fixed deposit where you get 6.66% every year and it's stable. In the case of debt funds in mutual funds, and which is why they have this long-term capital gains taxation, because they are marked to market. When interest rates come down, the price of paper goes up to manage that. It's a theoretical concept. And so you make mega money. In debt papers in mutual fund, when interest rates come down, you make mega money. When I say mega means you make more than what your yield is. Suppose you start at 100 rupees on day one. 100 rupees you invested in a 6% YTM debt fund. You should theoretically be at 106 after 1 year. But if interest rates in the meantime have gone down 2%, right? And this paper is giving you 6% while the interest rates have gone to 4%. The market will value it in a way that this 100 rupees will go up 2 rupees or 3 rupees because the interest rates have come down by 2%. And then you'll make your 6 rupees on the interest. So instead of getting 106 at the end of the year, you'll be at 108. So you made that 2% extra because the interest rates came down. And now look at the reverse scenario. When you are at 108, you would expect I'll go to 114, 115 with that 6%. But interest rates went from 4 to 7. When interest rates go up, the price of the paper is adjusted in a way that 114 which you're expecting will not reach 114. You will pay for the interest rates going up. Your price of the paper will come down. So you will make your 6% in the interest that will come. But the capital value of that, because the interest rates have gone up, will come down a little bit. So you will make only 2%, 2.5% instead of the 6%. So there will be years where you'll make more than 6%. There will be years where you'll make less than 6%. And which is what happened. 2020, 21 interest rates came down. So you made good money. And when interest rates started rising in 2021, 2022, you actually lost out in returns. And 2022, I think most debt funds have given zero return virtually or slightly higher. So that's the reason why debt funds have their cycles. But again, in debt funds, if you have a longer horizon, you don't need to worry about the interim. It's not a straight line, but yeah, if you have a longer term horizon, you'll probably be better off.
Thanks for your detailed answer. If you have any doubt regarding this or any other financial or investment decision, don't hesitate to book an appointment with our financial expert. The link to the appointment is given in the description below. And also, would you like to know more about finance and investment? Then we would recommend you to attend our live webinar. The link to the webinar is also given in the description below. The webinar is absolutely free. If you like this video, hit like, and if you are new to our channel, please do subscribe.